In this video, we continue our discussion on Chapter 13, in which we continue our discussion on deposit creation, where in our last video we went through an initial example of the deposit creation process, whereas in today's video we seek to continue this discussion by going over some preliminaries in order to define some reserve concepts in order to proceed to our more involved loan example, from which we'll conclude with the money multiplier, where in regards to our preliminaries, in our last video we saw that a bank making a loan increased the money supply in an economy by the amount of the loan. We now seek to continue examining this process to see the potential and limitations of it by considering a multi-consumer bank and firm world, where first let us recall our initial example, where we had one consumer, one bank, and one firm. We have the T account of the bank on the left and the quantity of the money supply on the right, where in our example we had the consumer deposit $100 cash to the bank. This created a $100 asset on the bank's T account, and they're now holding $100 in cash, but also a $100 liability in that they had to credit the consumer's checking account. So we have our assets equaling our liabilities, and in terms of the money supply from this process, the deposit of the $100 did not expand the money supply, merely it changed its composition in that the consumer is now holding $100 in terms of transaction account balances as opposed to the $100 cash that they originally had. So then after this deposit went through, with the $100 cash that this bank was holding on their asset sheet, this then allowed them to make a loan out to a firm who seeked to start or expand their operations, where with this loan, this required them to credit that firm's account, and they made the loan of $100, so a $100 credit, where this firm also has the responsibility in terms of paying the bank back. So the bank also gets a $100 asset added to their T account in that it's an IOU from the firm. So once again, here we have our assets equaling our liabilities, our 200 plus our 200, our 200 equaling our 200 as expected. And in terms of our money supply, now we have a change in the money supply given that through this loan, the money supply expanded by $100 in terms of the transaction account balances made by the loan. So an expansion of the money supply by 100. So then with our example covered, before we proceed to our next example, we must note that in our first example, the bank issued out a loan by the amount of cash it held in reserves, where reserves once again are defined as assets held by a bank to fulfill its deposit obligations, where in more general settings, the bank is required to hold a portion of their reserves, which will denote as required reserves, where required reserves will be determined by the Federal Reserve in that they'll give the banks a required reserve ratio in that they must maintain with respect to their total deposits, where anything in excess after these required reserves, the bank is then free to loan out, which we will denote this portion of the reserves as excess reserves. So given the distinction between excess and required reserves, this then allows us to state total reserves as the sum of required reserves as well as excess reserves, where through some rearrangement, we can express excess reserves as the difference between total reserves and required reserves, where in terms of required reserve calculation, given a required reserve ratio given by the Federal Reserve, that is the amount that the bank needs to hold with respect to their total deposits, where total deposits are going to be the sum of checking and savings account balances from our consumers and firms. We can then calculate required reserves as the product between this required reserve ratio mandated by the Fed, scaled by total deposits, that is the amount held in checkings and savings by our consumers and firms. So then with this decomposition and this formulation in terms of our total reserves, excess reserves, and required reserves, given a deposit from a consumer or firm into a bank, we are then able to calculate our total reserves, required reserves, and excess reserves given our required reserve ratio. So then with this information in mind, let us now proceed to our second example. For our second example, consider a one consumer, two bank, and three firm world, where a consumer makes a $100 deposit and the required reserve ratio is 20%. Here, first, let us consider the information that we have. On the left, we have the T account for Bank 1, which we'll designate as University Bank, and on the right, we have our T account for Bank 2, denoted as Eternal Savings. In this first step, it's just as our first example. There's a $100 deposit made by a consumer into Bank 1. The $100 deposit gets recorded as a $100 credit onto their checking or savings account, which the bank must pay back, which is a $100 liability, and also equates to a $100 deposit in terms of the bank, where with this deposit, the bank also gains $100 cash, which they can record on their asset sheet. So once again, in terms of assets and liabilities, we have $100 cash in assets and $100 in terms of liabilities in terms of total deposits, so 100 equaling 100. In terms of where our excess and required reserves come in, our total deposits is $100 balance in terms of our consumer account. We know our required reserve ratio is 20%. So 20% of $100 gives us a required reserve amount of $20. Our excess reserves is going to be the difference between total and required. We know that total is going to be 100. Taking the difference between our required amount of $20, this gives us an excess reserve of $80, where if we sum our required and our excess, this then gives us our total reserve amount of $100 as expected. And in this instance, just as we saw in our first example, here the money supply has not expanded nor contracted, merely changed its composition from cash held by the consumer to now a checking account balance held by the consumer. So now in our second step, Bank 1 makes a loan to Firm 1. So looking at University Bank's T account, they have $100 in terms of liabilities in terms of the credit on the consumer's account. Their excess reserves from our deposit was $80, so they're capable of making an $80 loan, which they make to Firm 1, Campus Radio, in which Campus Radio then gets a credit to their account, which must be paid to Campus Radio, and Campus Radio also now has an IOU to the bank in the form of the $80 loan, which shows up as an asset to the bank. So 80 equaling 80 in terms of this loan, and our initial deposit of 36 plus 64 equaling 100, equaling our deposit of 100. So our assets of 180 equaling our liabilities of 180. Where as far as now calculating our excess and required reserves, given that our total deposit is now $180, our consumer checkings and our firm checkings, scaling this, our 180 by a required reserve ratio of 20% gives us required reserves of $36. Where in terms of our excess reserves, it's going to be the difference between our reserves of $100 of the cash held minus our $36, giving us a total of excess reserves of $64, where the sum of these two will give us $100 as before. And as far as the money supply goes, with this $80 loan, the money supply has expanded by $80 via transaction account balances. So then now moving on to our third step, the firm spends the loan at another firm. So then what goes on is Firm 1 takes money out of their account and spends it at Firm 2, where by taking money from their account, this then removes balance from their checking account, and so this removes the liability from Bank 1's T account, but also removes $80 cash that they were holding, which would be in the form of their excess reserves. So 80 minus 80 on both sides of our liabilities and our assets. This only leaves us with $100 in terms of consumer account balances, in terms of our liabilities, as well as our deposits. And in terms of required reserves, 100 scaled by 20% gives us $20. And in terms of excess reserves, since the firm took out their $80, the bank no longer has this $80 in excess reserves, but they still have the IOU from the firm of $80, so we still have $100 in terms of assets, which will equal our liabilities. Since Firm 1, Campus Radio, spent their money at Firm 2. This then shows up at Firm 2's bank account, Eternal Savings. In terms of it's an $80 credit to their account, which also creates an $80 asset in terms of cash held by Bank 2 of $80. So Bank 2 now has $80 in assets as well as liabilities, where with an $80 sum of total deposits, our required reserves for Bank 2 will be $80 scaled by 20%, giving us $16, or the difference between our total reserves of 80 subtracted from our required reserves of 16 will give us our excess reserves of 64 for Bank 2. After which, now that Bank 2 has some excess reserves, they make a loan by the amount of their excess reserves. So our T account for Bank 1 stays the same, but now for Bank 2, given our excess reserves of $64 from our previous transaction, Bank 2 now makes a loan to Firm 3, Herman's Hardware, by $64. This then expands the money supply by $64 and creates a further liability that the bank must now pay. But at the same front, Herman's Hardware now must pay Eternal Savings $64, so this shows up on their asset sheet as well. Summing these components, we have our assets equaling our liabilities of 144 equaling 144, where our total deposits will be $144, these two firms' checking account balances. Scaling that by 20% will give us our required reserves of $29. And in terms of our overall $80 quantity in terms of reserves held at the bank, our $80 minus our $29 will give us $51 in terms of excess reserves as expected. Now, overall, what we saw then with this process is that Consumer 1 made a deposit to Bank 1, where this then allowed Bank 1 to make a loan to Firm 1, from which Firm 1 spent that loan at Firm 2, where Firm 2 deposited Firm 1's spending in Bank 2, which then allowed Bank 2 to make a loan to Firm 3, where at each step of the way where a loan was made, the money supply increased. Where the amount of the money supply increased by each step, the loan amount decreased, where overall this process describes that of the money multiplier, which is the amount of deposit dollars that the banking system can create from $1 in excess reserves, or mathematically this is going to be 1 divided by the required reserve ratio. And that the process that we have here is, given our circular flow on the right, the public starts out with some cash on hand, consumers or firms. They then make a deposit to the bank. This deposit then adds to their total reserves, which then expands their required reserves as well as their excess reserves. With an addition of excess reserves, this then allows the bank to make an additional loan to a consumer or firm, where the consumer or firm now has additional transaction account balances, which they can then choose to take out and spend at another firm or with another agent, which therefore then adds to that agent's checking account balance at some bank somewhere else, which then further adds to a bank's total reserves, which then adds to their excess and required reserves as a result. And then this process repeats again in that an additional loan can be made, and this process repeats itself until the amount of an additional loan made reaches $0. Additionally, this process also then describes the two functions of banks, in that they can transfer money from savers to spenders or create money via loans. We're describing this money multiplier process through our example. We had an original $100 deposit, which then allowed Bank 1 to make an $80 loan, which, after through some steps, allowed Bank 2 to make a $64 loan. And if we were to continue looking at this process, Bank 3 could make a $51.20 loan, and then so on and so forth until the last loan at step N would be $0, where the sum overall would then allow for the money supply to be $500, where potential deposit creation overall then, given an initial deposit, can be expressed as the excess reserves scaled by the money multiplier, or in our example will be a value of 5 in terms of the money multiplier, a deposit creation value of 400, and the money supply, our initial deposit plus our potential, of 500.